We've all heard about Bitcoin and how it made thousands and thousands of people rich overnight. You're working your ass off day and night, barely making enough to keep living your mediocre life. And then you open Instagram and see a 15-year-old kid make $50,000 from Fartcoin. It's tempting, right? But nobody shows the other side. Around 9 out of 10 people who try crypto trading lose. At some point, you have to ask the question most people in crypto avoid. Is this actually trading, or is it just gambling happening on a different app? And can you actually make money through this? Let's get into it. So first of all, we need to define gambling properly. Gambling is when you put money on something where the outcome mostly depends on luck. You are not controlling much. A slot machine works like that. Roulette works like that. You put money in and hope probability lands in your favor. Now look at meme coins. Dogecoin, Shiba Inu, Pepe. Most of these coins move almost entirely on attention. People get excited, money floods in, the chart goes vertical, and eventually the attention moves somewhere else. That is why meme coins attract so many gamblers. A lot of people buy them exactly like lottery tickets. They see a coin trending on Twitter, throw money into it, and hope they accidentally found the next 100x before everybody else. But there are also traders approaching these coins very differently. They track wallet activity before hype starts. They monitor volume spikes. They pay attention to social sentiment alongside actual on-chain movements. Some of them already know where they are taking profits before they even enter the trade. At that point, the process starts looking closer to real trading. The difference is not really the coin itself. It is the process behind the decision. The same meme coin can be a calculated position for one person and a complete emotional impulse for somebody else. And honestly, streamers are probably the clearest example of this entire divide. XQC is one of the biggest streamers on the internet. Millions of people watch him live. He is also one of the clearest examples of what meme coin trading looks like when there is no structure behind it at all. He has gone live multiple times, opening trading apps and buying meme coins completely on impulse, while thousands of viewers watched in real time. Absolutely no thought behind it whatsoever. Just clicking buy because a coin looked interesting in that moment. There was one stream where he lost around $200,000 in a single sitting, live, in front of hundreds of thousands of people. And the weirdest part was how normal it seemed to him. He barely reacted.
For a long time, but if it's over for too long.
Which tells you how differently somebody behaves around risk when they make millions from streaming every year. For XQC, the losses become content. The actual problem is what happens to the audience watching him, because millions of people start seeing meme coin trading as entertainment and easy money. They see somebody casually throwing huge amounts of money into random coins and surviving the losses. Then they try copying the behavior themselves with money that if they lose, they won't be able to pay next month's rent. That is where the line between trading and gambling starts to blur. The difference is everything happening before the trade gets opened, and most of that part never makes it onto the stream. That is exactly why tools like FOMO are useful. One thing that keeps coming up in these stories is that most people are trading completely blind. They do not know what experienced traders are actually watching or doing before the hype starts. FOMO is a social trading app that shows you what the top profitable traders are actually doing in real time. Their moves, their watch lists, the coins they are paying attention to before everybody else piles in. It gives you actual visibility into trader activity instead of forcing you to rely on social media hype. Link is in the description, and you can use code DGENSTORIES for 10% off on fees. Now look at celebrities. In 2021, Elon Musk posted a picture of a Shiba Inu dog on Twitter. Within hours, Shiba Inu, the coin, exploded over 300%. Billions of dollars moved because of one image from one person. The people already holding the coin before the tweet made absurd money almost instantly. The people who bought after seeing the chart explode mostly got trapped when the hype cooled down. Same coin, same day, completely different outcomes. And the difference came down to timing and preparation. The people chasing the move emotionally were gambling. The people already studying unusual activity around the coin before the tweet had an actual edge. That is what makes meme coins dangerous. From the outside, emotional gambling and calculated trading can look almost identical. Both people bought the same coin, and both probably believed they were making a smart decision. One had a plan, the other had excitement. Now compare XQC to Logan Paul. Logan promoted a project called CryptoZoo. The idea was that users would buy NFT eggs, hatch digital animals, breed them together, and earn money from the system. Real people put real money into it because Logan was publicly backing it. The project barely functioned. Features were missing, systems were broken, and some parts never properly launched at all. People across the community lost millions of dollars. Logan later said he wanted to make things right for investors, but the damage was already done. And this is where the conversation changes slightly. Most of the people buying CryptoZoo were not studying tokenomics or researching blockchain infrastructure. They were trusting somebody famous. That becomes less about investing and more about betting on another person's reputation. Now compare that to somebody like Snoop Dogg. Snoop approached crypto much more carefully. He worked with projects that actually had visible teams, partnerships, and long-term involvement behind them. Not everything succeeded, but there was a clear difference in how he moved through the space. That same contrast keeps appearing throughout crypto. One side moves emotionally and impulsively. The other moves with structure and patience. And that difference matters more than the coin itself. Now here is the part most people underestimate. Smart people lose money on meme coins constantly, not because they are unintelligent, because meme coins are built almost perfectly to trigger emotional decision-making. Researchers studying gambling call this the variable reward loop. It is one of the main reasons slot machines become addictive. The reward is unpredictable. Most attempts fail, but occasionally somebody wins huge, and that possibility keeps people coming back. Meme coins operate on almost the exact same psychology. One random trader turns $500 into $50,000 overnight, and suddenly thousands of people start believing they can do the same thing with the next trending coin. The traders who survive long-term are usually the ones who recognize that emotional cycle early and stop it from controlling their decisions. The people who lose everything are usually the people who slowly stop following systems and start following emotion instead. And over time, that difference becomes very obvious in account balances. So, is meme coin trading gambling? For a huge percentage of people, yes. They are buying based on hype, excitement, and gut feeling while hoping the chart keeps going higher. The fact that it happens inside a trading app instead of a casino does not really change the psychology underneath it. But that does not mean it always has to work that way. There are traders making real and consistent money from meme coins because they actually treat it like a system. They manage risk carefully. They track wallet activity before hype starts. They plan exits before entering trades. They approach it with discipline instead of adrenaline. And honestly, that is probably the clearest way to separate trading from gambling. The coin itself does not decide what kind of trader you are. Your behavior does. Every trade is either part of a system or part of an emotional reaction. And after enough trades, the difference between those two approaches becomes impossible to hide. Think about the last coin you bought. Was there actually a plan behind it? Or did the chart just look exciting in the moment? If you want to start making decisions based on actual trader activity instead of pure hype, check out FOMO in the description. See what experienced traders are actually watching in real time and use code DGENSTORIES for 10% off. Thanks for watching.